Okay. Hello, everyone. Welcome to the November Business First Wednesday year-end tax planning and record keeping for small businesses. I'm Melissa from the Business Insight Center at the Central Library of Rochester in Monroe County. Thank you all for joining us today. If you're in the local area, I hope you're all still warm. Remember to mute your microphones, and any questions you have, enter into the chat, and we will be answering them throughout the presentation. So I'm going to hand it over to Tim from the Small Business Development Center.
Okay, thank you, Melissa. Good morning, everybody. Welcome. Happy November. So I work at the New York Small Business Development Center here in Rochester. It's about 22 centers throughout the state. If you'd like to set up an appointment with us, the best way is probably our website, www.nysbdc.org, and just click on make an appointment. Oh, thanks, Gina. One of our other advisors put that in the chat. Thank you very much. And happy to introduce our speakers today. They've spoke at this event before and do a great job. So Linda Wiener and Jessica Drachler, they're both managers at Allied Financial Partners here in Rochester, going to give us a nice presentation on an important, exciting subject, year-end tax planning and record keeping. So Linda and Jessica, please take it away. If you have questions, like Melissa said, put them in the chat, and Melissa will be the moderator for that. So Linda and Jessica, it's all yours.
Okay, thanks. All right, so just to tell you a little bit about ourselves and like where we work. So Jessica, I worked for Allied for about 5 years. We have 5 different locations across New York. Buffalo, Rochester, Perry, Oneonta, another location in Victor. We've been growing a lot. We have, as of now, I think it's around 76 employees. 21 of us are CPAs. We also have financial services and benefits in out of our Victor office as well. Another growing thing that we're working on is doing cost segregations for our clients as well. So.
Linda Wiener, and I've been with Allied about 8 years and have probably about 20 years of experience in the field. So we'll move on with our presentation. The first thing we want to talk about is the type of entity. Many of you are probably sole member businesses. Maybe you haven't even started your business yet. And that means when you file your personal return, you're going to file a special schedule for your business. If you're just a general business, it's going to be a Schedule C. It might be a Schedule E if you're rentals, or a Schedule F if you're farms. There's 2 other types of businesses, mainly a corporation. We wouldn't recommend a corporation for most businesses, but we might suggest that they become a subchapter S or a partnership. And we want to just talk a little bit real quick about the differences between those 2. So in an S Corp or a partnership, S Corp you can have 1 owner or more, and a partnership you can have more than 1. And there are some differences as to what you can and can't do. And we're not going to really get into corporation. It's very similar to an S Corp. They file their own separate returns. And in an S Corp, the owner can go on payroll. We highly recommend that. Typically, we suggest that they pay themselves at least as much as they would make if they were doing that job on the outside, if they can afford that much when they start out. But eventually that's where they should be. Any extra money is taken out as a draw. And there's reasons for doing that related to how the money that comes out as a draw is taxed. In a partnership, you're going to have to split the earnings for the partners. You don't get to go on payroll. And you do get to report that on your return, both for a sub S and a partnership. There's a schedule called a K1 that you would add to your returns. There's another little glitch to that. If you have a profit in either of these corporations and you put in money in the corporation and you've been running a profit, then that's all coming over to you. If you have a loss, you can only take the loss to the amount that you've contributed over the years. So it gets a little complicated, and if you're forming either of those, you better be talking with your accountant, and if you are forming one, work with an attorney so you do it right.
Yeah, to add to that, don't just go to an attorney, you should definitely be working with them. We've had some clients come in and they've already met with the attorney, they didn't meet with us beforehand, and they've already had their entity set up. Sometimes the type that they choose just doesn't necessarily make sense for, where their business is at or kind of what their goals are. So make sure that you're actually talking to an accountant about, if you're gonna start a business or you're thinking about, if you're a Schedule C right now, but your business is growing, like what, where would you benefit as entity types? So make sure you keep accountants in the loop on that and, really talk to them. So you don't end up filing unnecessary returns and making your life more complicated than it needs to be.
And if the attorney sets you up as a corporation, but he or she doesn't do the S Corp election, you have a window of time in which you can do that. And if you don't even tell us that you set up a corporation early in the year until you give us our stuff at the end of the year, we're too late to make that election timely. And I have a client that it took 2 years to get that through. And in the meantime, we were confused as to what type of return to file. There were notices going back and forth, and it was a nightmare. And it cost the individual a lot of money because we put a lot of time into it. So as Jessica says, make sure you're working jointly.
Mm-hmm. Yeah, and that's very common. We've had a lot of clients who didn't tell us. They almost always, it drags out for years working with the IRS in New York State, trying to get your return filed. Typically it rejects when you try to e-file it, so you need to paper file it, and I don't know, the IRS in New York State really love to lose paperwork, so make sure you're working with accountants on things like this. All right, so to really have, how do I want to say this? So for your year-end planning, this is kind of what we're focused on. That's what I'll start with. You really need to start with your day-to-day record keeping, your bookkeeping. Whether or not you keep that on a spreadsheet, you use something, a lot of our clients use QuickBooks. I have a few that use ZipBooks this year. I'm not sure if there's any other software you guys are using, but let us know what they are. But it's important to keep track of what is coming in and out of your bank accounts at the very least. And even if you're just using a spreadsheet, you should have your balance sheet items, tracked somewhere. I have a client who has a spreadsheet set up. She puts in her income and expenses at the end of each week. And she also keeps track of balances of the few loans that she has and her checking and savings account. She makes sure they always pay out. And that's easy to do if you have something like QuickBooks or ZipBooks.
But even if you have a spreadsheet, Jessica mentioned balance sheet items. So your balance sheet items are the things you own. So it's your cash in the bank. It's anything called assets. And I'm not going to get into specifically, different types of assets, but they're mainly things that are big and have a big price tag, okay? Think of it like that. If you don't know where to put it, just put it as an asset and talk with your accountant and say, I bought this stove, or I bought a cart that I can wheel things around in. Some things will be an asset, some won't. And then any money that might be owed to you, even though you won't be reporting that because we report on a cash basis, you do need to keep track of that somehow. Money that you owe people, and then that would be basically the equity in your business. We'll worry about that. But if you can keep track of those things separately, if you're using a spreadsheet, it'll work out. You could do a spreadsheet where it's every month. You just list the expenses and then the dates if you want, or it could be daily, or it could be whatever works for you. If you're working with an accountant, again, talk to them, show them what you're doing so that it'll be easier for them to summarize. If you hand us a bunch of papers and say, here's all my receipts, you're going to pay a lot of money to your accountants to get that sorted out, and it's something that you should be doing. And most of the time when I give a talk about starting a business, I talk about the fact that if you haven't allocated time to do the business part of your business, then you better be thinking whether you have time to do the business, because that could be a whole day a week that you need to spend or more doing your books, or pay somebody, and that's going to be a pretty hefty price tag.
Yeah, definitely the biggest thing is trying to keep track throughout the year. Like I have a client, she does it weekly. Some of them do it quarterly if they're using like QuickBooks, and then they call me and, you know, we got an hour on the phone of just kind of going through their questions. I'd rather see people doing that than, you know, bringing me a baggie of receipts at the end of January for the entire prior year. You know, it's a lot of time wasted, and as Linda kind of mentioned, the more time we spend, the more, you know, it costs you. So if you're able to kind of keep track of this stuff on your own, it's best. Or, you know, we have people who come in, we do bookkeeping for a lot of clients as well. Either, you know, weekly, or we go in monthly, some are quarterly, depends on, you know, what you want to see and how much volume you have in your business. So, you know, talk to an accountant. If you think you need help in this area of keeping track of everything, making it easier. And for year-end planning, if you don't have, you know, any idea of what your income and expenses are, or, you know, what your profit's going to be, it's kind of hard to plan for, you know, what you might owe in tax, you know, come April 15th.
So we're talking about tidying up your books at the end for 2023. So there's several things that you need to know the IRS can match. And this isn't only for your business, this is personal too. So if you, the W-2s. So basically, if you have payroll, the IRS can match what gets filed to the IRS. If you're off, you're going to get a notice from the IRS, or they're going to make a correction if it's small. There's something called 1099s. We'll get into those later. But, you know, that's the biggest area where I have problems with individual returns, where somebody opened up a new investment account or something, or a new bank account, and they didn't give it to us. And now we're getting, this time of year, notices from the IRS, you underpaid your taxes, and they're hitting them with interest and penalties. And the person says to me, but I gave it to you, and I go through my files and it's not in the documents that they gave me. So make sure you collect all those up and make sure the amount that's in your books is equal to the bank says. Your bank loan balances, as Jessica mentioned, the interest that you paid. Reconciling your cash and credit cards accounts through the end of the year, making sure that those agree, the balances on your books or that you're tracking agree with what the credit card or bank company or bank says that you have at the end of the year. Review your reports, make sure you see that things make sense. And then one big thing is we do business organizers for businesses. We also do them for individuals. And I'm going to say the people who bring in their stuff, use the organizer, kind of sort their data, and even check off in the thing that in the organizer, yes, I have the W-2s, or I have my bank account information. We at least can get it organized, scanned into our system, and finish it in a reasonable amount of time. If you just throw, again, a pile of paper at us and you don't use your organizer, you might have forgotten something, then we're calling you. I have somebody who gives me their stuff every year in January, and it's March before I get every piece of paper, and I'm picking up that return and putting it down. And every time we pick it up, we have to remember where we are, and in those cases, I am definitely billing by the hour. So you need to keep that in mind. Anything you want to add?
Oh, yeah. So I think the biggest thing for finishing your year right and tidying up your books is making sure that you do reconcile your cash. I think that's like the bare minimum you should be doing. It's really important because you know, like, where you're at. A lot of clients, especially with QuickBooks account, some things can be doubled. Or if you have, like, if you are using QuickBooks, you know, you can connect your bank account, but like some transactions don't always come through, so your balance seems off, you don't know what's going on. I think most importantly, because I've actually had a client experience this recently, is that they took a bunch of checks that they received to deposit into their account. And one was supposed to be for $1,000, but it got typed in as 100. So as we were reconciling the cash and we were going through and matching the bills that were paid from their customers, tying everything out, we noticed that there was like a discrepancy. We had to go back and find it and, get a picture of the check that from the bank and make sure that it was, for the 1,000 before it went after their client. It was a whole ordeal, but they were able to get $900 back because they were owed it. It was just an error by the bank. People make mistakes. You want to make sure that, your bills and everything match and your cash makes sense. So you're not losing out on money and things like that.
Yeah, the important thing about reconciling is, so at some banks also, you can look at the check deposits and they'll show the picture of the check. So we have a company that just goes to the bank, puts the deposits in, and then we have to go and see, well, what did this get deposited to? Which account, or what's it for? What customer? But there's other banks that don't do that. So if the bank that you're using doesn't do that and you hand this over to somebody for bookkeeping, they're not going to know where to put that big deposit. So you need to scan those checks ahead of time, take pictures of them, whatever, because each one has to get applied. And some might be for certain types of things that you sell, other might be for services. So you need to break that out. You can't just post it all to income. Unless if you're a consultant and that's all you do and they're giving you checks for consulting, it's up to you to track which person paid or not, but that can all go to one area. So that's the most important thing you can do. And a lot of people think the bank is right. And also when you download from QuickBooks, there's also a way to set it up so you can do a checking and make a decision if you want to put that in the books or not. And it'll tell you if it matches something already there. But if you don't, that's sometimes how things get double entered. And we don't find it till year end if we're not looking at your books regularly. I also find people who do reconciliations and there's all these old outstanding checks and deposits they never cleared out. And now we've got to go figure out what that is because they're probably duplicates or they made a mistake in the entry and then they put the difference to bank adjustments or reconciliation adjustments. There should never be a reconciliation adjustment. You should really try to get those banks reconciled. And if you're an individual and you're running everything through your own account for some reason, then it's really important because you're going to need to divide those out. I wouldn't recommend you do that. You should have a bank account separate from your personal stuff.
All right, and if you are using an accountant and you do have, if you're using like QuickBooks or ZipBooks or something like that, feel free to ask your accountant for any adjusting journal entries that they made, for whatever reason to your books. Say you had something posted incorrectly, like say you're trying to expense like a $5,000 piece of equipment when really, that has to be depreciated. So, it gets moved around a little. Or if they end up just helping you kind of clean up your books and make sure everything's right. So we do that for some people as well. But we always have the adjusting journal entries. We either have them readily available in our software or there's something that we can create. But make sure you're asking your accountant for those types of things. That way your books are correct going forward. This will save time and money. Well, it'll save time for your accountant, which then saves you money. Come year end when we're starting to do your tax return. The other important thing is, so once you get those adjusting entries from your accountant, you should not be making any other adjustments to that year other than what your accountant made. So don't go back and change anything. This is especially important for S corporations and partnerships, because if you start moving stuff around and it ends up like profit loss is different, we have to spend time figuring out what you moved and why, and kind of get it back to what we had already filed in the return. And it's time consuming and then, it adds to your bill. So
if you find something from the prior year that didn't get in, then if you're using an accountant, call them and say, what should I do? For anybody, we've already filed your return. We can't go, you don't want to go back and amend for a small amount, but if it's a huge amount, we may amend that return. If it's a small amount, it's probably not going to hurt to post it in the current year. But again, make sure you're not touching prior year because it takes a lot of time to figure out how to get those numbers for year end from the year before right for the current year.
Yeah, and if you are using, I know QuickBooks Desktop and online, you can actually set a password so you can't make adjustments without like a screen popping up and asking you for the password before it'll actually post. We do that for some clients, kind of as a reminder, like, oh, maybe I shouldn't be doing this. Let me reach out to my accountant. So you can consider that as well.
That happens sometimes at the beginning of the year. You're posting stuff in January and you're using 2023 and it's for January 2024. I find myself doing that. And when the password pops up, you're like, oh yeah, I have used it the wrong year. And you're just so used to doing that. So it's just a good safeguard. Our fun area. Jess and I have been in charge of this for the last few years in our firm, and it can be a nightmare. The government 1099s I mentioned, they're something that you have to send to your vendors who provided a service, or if they're an attorney. Okay, so typically contractors, attorneys, people who you may have hired to come in and do some work, but don't pay them on payroll. If you paid the vendor over $600, you have to issue them a 1099. So what I tend to do is tell people, we do have a copy of a W-9 in this slide. I think it's next, right?
Yep.
And so we're going to show you that. So you get this W-9 and you send, every time you get a new vendor, give them the W-9 and they're going to say, well, I don't need to fill it out. And you're going to say, please fill it out. Because some of these people think that they're a corporation, but they're not. And we need to know what social security number or tax ID number they're using. So here's John Doe with his landscaping company. And he might say landscaping, JD's Landscaping LLC, I'm a corporation. I don't have to, you don't need to give me a 1099. Well, yes, we do if you are an LLC and an individual who's filing a tax return. So if it's a C Corp, we don't have to give you one, but so if you get this, if you can get this from everybody, then just keep it on file. The employer ID will tell you whether we need to file or not. On the bottom right, you can see that there's an employer ID number instead of a social security number. A lot of these people will check one of these boxes and put a social security number in. That means they definitely need a 1099. So why are we pushing this? Well, the problem is that this is required to be reported because there can be some fines. We're going to get into that. But the other thing is, if people don't want to give you one, you still are obligated to document that you didn't get one. So basically, in the past, you could manually fill these out. The IRS would send you paperwork and you could fill them out. But if you're doing 5 or more, you do have to use software. So I'm going to let Jess talk about this a little more because she's kind of heading it up this year at our firm.
Yeah, so I just want to go back real quick about documentation. So I go back to this here. So if you fill this out, I usually try to put at least one of their names in, give it to them to fill out, see what they're checking here. Because if it's C Corp or S Corp, you don't need to worry about it. But for next year, you just keep it on file, make a note, somewhere not to ask them again. And make sure you're keeping track of this stuff. I've had clients that I do bookkeeping for that I reach out. Like I'll be the one reaching out to these vendors asking for this, and some just don't respond. And I'll ask again. And if I never get a response, I usually print out the emails that I sent, where I know like when I tried calling or something. So if the IRS does come back and want to give you fines because they were supposed to receive one, you have proof of some form that here's the emails I sent. Here's the form I tried to fill out. They wouldn't do it. I tried calling them on this day. They told me no. So make sure you're keeping track of that. It's not I haven't seen very often IRS come out just trying to get you for 1099s. It typically leads from if they're auditing you for something else. And that's when they start nitpicking through everything, and that's when they're likely going to catch things like this as well. So make sure that you're keeping records of all this, and it makes sense.
They could be auditing the vendor. And if that's where we would see it usually, they are auditing a vendor and they're looking for their 1099s because they find stuff that they should have received one for. And then they find out that, oh, your company was provided, use them, now they're gonna come after you. So they're going to get hit for not, not having it possibly, or they're gonna get fined because it didn't end up in the right place or the accounting's wrong. And usually that's where the problem is. And then you're gonna get hit for not filing it unless you did keep some type of proof that you asked for it and you didn't get it. And my suggestion is if you keep asking and they don't give it to you, I ask, why are you using them? I have a company, cleaning is the best example. You have somebody cleaning your office space and they won't give you a 1099. And most people who are doing cleaning right now won't do that. And they're few and far between for people with a reasonable price who can clean an office. So you have a hard time finding somebody who has workers' comp and they're willing to fill out a 1099 or a W-9. And that's where you could get caught big time. And it's just not only the 1099, it leads to a lot of other stuff.
Mm-hmm. Yeah, so make sure reach out with those if you're using a new vendor for cleaning, small like repairs and maintenance is normal as well. Landscaping was a good example, attorneys, and even like if you have a building that you're renting from somebody, rent should be on a 1099 as well. Yeah, so try to keep track of that throughout the year. We have some clients, actually I think we have too many clients who don't ask for this information throughout the year, and then we're scrambling during January because they're required to go out to the recipient by January 31st of the following year. So, we don't have a lot of time. Right after New Year's, you come in, you have to get your books cleaned up. If you didn't do that, gather the vendor information. Look at the totals that you paid them throughout the year. So again, it'll save the accountant's time and you money if you are able to gather that information and have it ready for them, mid-January, rather than having us try to call. And we have a few clients that do that as well. Like they'll ask us on January 25th, like, hey, here's my list, but I don't have all the information. Can you guys help us get it? Because you guys are busy too. If you're running a business, you're doing stuff as well. So we get it, but we try to encourage everybody to keep track of this stuff throughout the year, so we don't have that scramble, before the deadline.
So if you haven't given W-9s out to your vendors, and if you have a question, should I give it to them? Give it. You're better off giving it to them, letting them fill it out. They don't need one. I would do that right now. I would go through my vendors list. I would send them out now. And if any new vendors come your way between now and the end of the year, get them out there. If you have to ask a couple of times, at least, maybe they didn't get the first one, do your best, because we have less than 30 days to get this data together, get it in our system, get it filed, and hope nothing rejects, and then refile or following up with you. And it's that last minute. We're usually there right up till midnight. We usually got a team that are, putting this stuff in so that we can file this on time. And it's all because we don't get the data timely, and it's a lot of pressure on you guys to do that last minute.
Okay, we have a question. How long can you keep the W-9 on file before it's considered too old or expired?
Forever, I think.
Yeah, as long as, if you notice like your vendor name changes slightly, like, I don't know if they end up changing the kind of entity they are. Like if they are like a Schedule C, and then you notice that they're all of a sudden like, I don't know, now you notice that they're,
Inc.
Inc. or LLC afterwards, then you could ask them again, like, hey, did your entity type change? And then you can ask for like a new W-9.
Or you could just send them out, just in intervals. But if you know the entity you're working with, they may even tell you, maybe an address changes, maybe who you write the check to changes, then you would want to issue a new W-9.
We have another question. I have a mobile boutique inside of a box truck. I had repairs done to the engine of the truck. Do I get a 1099 from the auto mechanic?
So to get this correct, so
It's a repair on his.
if it's a repair on your vehicle, you do not get 1099.
You have to give. You would have to give him a W-9.
Yeah, so you have to give the mechanic a W-9 and see if it's,
And if the vehicle, if the vehicle is in the business name, then that's part of your business assets. And anything you do to that vehicle for repairs, you would need to get a W-9 from that vendor. So if you got your next door neighbor doing some work and you're handing him over some money, I mean, that's up to you, but you really should have a W-9. And, if you're putting that on the books, because if you get audited or they get audited and you say, well, they might not find out if I pay them in cash. Well, yeah, they might, because this guy is buying things that are more than he could afford for the income he's reporting or for the investments he has. The IRS gets kind of weird. Every year they pick an area that they're going to look at. So one year they did farm markets, and everybody I knew who had a farm market got audited. Another year it might be another type of business. And when they're auditing, they're going to walk away finding something, because they just spent a whole week at your place. And if they find nothing, it's like they've got to find something so that they can get their little kudos and you did a good job. And you're hoping that what they find is something small. I had a medical practice once that got audited for tax, and it was related to whether the medicine was in the vial or not in the vial. If it's in the vial, then it's not taxable for sales tax. But if it's not, then the vial is taxable for sales tax. And who would have known? So everybody got dinged. But it's stuff like that they will find something. And so you don't know if the vendor you're using will get audited. You're saying, well, I won't get audited. I did everything I'm supposed to. But you might have the type of business they're going to audit anyway. And you might be one that they pick for some reason. So just when in doubt, anybody doing work for you, give them a 1099 or a W-9. And then work with your accountant. If you're doing your own filing and you have more than 5, then you're going to have to buy software. And the software and the forms and everything aren't that cheap. So you might want to think about using an accountant for this, because the cost really isn't that high. And if it's done right, then you got somebody to fight your case for you too. Okay. Good. Any other questions?
Nope, you can keep going.
All right, if you're using payroll, your payroll company will do, if you're doing your own payroll, I'm going to suggest highly that you consider not doing that. We find too many errors with people not filing timely or making mistakes. If you need to find a payroll company, I'm sure the SBA can help you, or your accountant. You can call us. We have a few small companies that do payroll and the big companies, but there are quarterly and year-end filings that are due. The quarterly at the end of the year is due by January 31st. All the payroll companies will have them out timely, or the reputable ones. You got to get your accountant copies of your year-end payroll reports in W-2. And when we're looking for payroll, we want a payroll that shows the full year with the total for the year. We want to be able to tie that out to your books. The reason is too many people take and post payroll based on what went through the bank. If you look at your W-2 or your own payroll stub, if you've ever worked, you're going to see that you might earn $1,000 for the week. But what you take home might be $800, because $200 is taken out for various taxes. But as a company, you get to write off the full $1,000. Too many times when the people post the net, they're underreporting their payroll expense, and it's wrong. And again, it's one of the areas the IRS can match. So you definitely need to get those reports, get them to your accountant so they can help you properly post. Some payroll companies have a general ledger ability where they will give you the journal entry for that payroll. Just make sure your accountant looks at it to make sure it's right. And then you can post from that journal entry every payroll, and it should be right. There'll be a few little tweaks to do because there's some weird tax taken out at different times that might get posted wrong. So, anything else?
Yeah, so I'm really just gonna kind of go through a quick example because we spend a lot of time here. We're cleaning up our clients' books that they send over to us, and they're like, everything should be good to go. They send us the W-2s, and then we realize that the wages and the payroll expense, neither of them match. And we're like, well, let's do some digging. We just have to find, spend time doing that. So just want to go over a quick example. So you're running payroll, ask your payroll company for that journal entry. They should be able to provide you one. So it saves the accountant's time and you money. It's your goal for keeping your books tidy. So a quick example, just so you can see what we're talking about. We're using one employee's salary is $1,500 a week, and you can see direct deposit and the taxes that are taken out. Which I set up a spreadsheet here, and here's kind of the breakdown. So, like the previous slide here, you have the breakdown of the employee's salary. So they actually earn this $1,500, but they're only getting $1,100 of it. They had federal income tax, state income tax, your FICA and Medicare was held. That gets you back to your $1,500, but again, you're only getting 11. And the other part of this is that, you as the employer, you also have to pay taxes. So you have to match the FICA and Medicare, from your employees. And then you have federal and state unemployment tax, which is only the employer side of it. And what you end up seeing hit your account this is very simple example, but typically you have three amounts come out of your account for payroll. You have your direct deposit that's going to your employee. You have the total taxes for the employee and the employer. So it's this 175 and the 400 for these amounts, all the taxes, and then usually a processing fee that your payroll company provides. What people tend to do is they'll post this direct deposit to wages, this total here to payroll taxes, and then a professional fee account for the processing fee. But that's not correct because the wages that were actually paid is $1,500. That was the expense the employer for wages was $1,500. So this is more of what your entry should look like. You'll have credits hitting your bank account for the amounts that are being pulled, but then the expenses are off. As you can see here, your actual payroll expense is $1,500, is your wages, the employer portion of taxes, and then your processing fee. And they balance out. This is just one of those quick things that you can change within your books if you are running payroll to be able to accurately see what you're spending on payroll and things like that, and saving time for your accountant, saving yourself money. Because sometimes I shouldn't even say sometimes. A lot of times, if clients aren't using like a proper journal entry setup, they're posting wages and taxes to multiple accounts. We really have to dive into their books and look at each expense account, trying to find where their payroll wages were to make sure that we can make an adjusting journal entry to get them to the correct, out of the wrong account and into the correct one. We can spend a lot of time on it. And reading the payroll reports isn't necessarily, depending on what you're using, isn't the easiest thing to read as well. So if you are using payroll, make sure you ask and see if they can provide you a copy of the, usually called like a general ledger or journal entry, that you can then just put in yourself.
If they do offer that service, you're going to have to tell them what some of the items are.
Mhm.
So if you're using an accountant, they can provide that to you. If you don't, you need help, you're probably gonna need, the payroll company doesn't know how to do bookkeeping, okay? Your payroll agent doesn't know that. And they can't set that up for you. So you're may need some help for that. If you're not keeping books where you're tracking your debits and credits, like in QuickBooks, at least do look at what Jessica said, and that you've got a total payroll of this cost of $1,500. It's just, you've got a total payroll cost of the $1,100 plus the $575, and then the fees, so it's $1,675, and then your fees on top of that. Payroll processing fees are easy to post as an expense. Post your taxes and post the deposit if if that's what you have to do. But you basically do have more to report than just those numbers. So get some help on that. It's not an easy thing, and if the SBA can't help, they may be able to recommend how you can get some help on it, or again, your accountant should be able to provide this.
We have a follow-up to the previous question.
Yep.
Could the auto repair on the mobile boutique truck be recorded in the books as an operating expense instead of getting a W-9 from the mechanic? Or are you saying a W-9 is needed anyway in this case?
Yes.
Yeah, the W-9 is needed anyways. It's still an expense for you, but you still need the W-9.
The W-9 is what gives you the data to give that person a 1099. The 1099 is a separate tax form. It doesn't go on the books. The expense goes on the books, but this is another type of tax reporting that you have to do. And if you don't have that data, which includes the tax ID number, the name, the address, and the type of business, you're not going to be able to fill out a W-9 or a 1099. Sorry about that. Hope that helps.
We have
Okay.
another question.
Yep.
I partner with a 501c3 company to provide state-funded income-based housekeeping services to clients. They identify what the clients need and then partner with my company to provide the actual service, and then they pay us. Since the company is tax exempt and receives funding from the state, they cannot charge sales tax. Since the program is income-based, occasionally the client has to pay a portion of the cost of services to us. Should my company be charging sales tax to that client like we would for a private pay client?
I don't know.
That's a good question. I had to do a little research on that.
Yeah. Yeah, I don't know. If you're saying that you would typically charge sales tax for a service, then if the agency, the overriding agency, the state agency, might be able to provide you with some guidance on that, because maybe there's an exception because of the type of client, and I don't know, but when in doubt, I wouldn't want to not charge and then get an audit and find that I was supposed to be charging all this time.
Yeah, probably ask your overseeing agency there if they know. Yeah, or if you do have an account, maybe they could do some research for you. Because there's exceptions to like every rule that they make, so I don't want to lead you in the wrong direction.
If it was the not-for-profit, if I work with a nonprofit who pays for things for the client, then the client gives them money, and then they buy what the client needs. And I don't think there's sales tax being charged either way on that. But if the company could collect all the money from this individual and then pay you, that might be a different way to handle it. But I again, check with the agency, the state agency. Okay, we're gonna get into tax planning. So your last estimated payment, let's talk about what estimated payments are. If you have a business and you're reporting it on your Schedule C or either F, or if you are an S corp or a partnership, money's gonna flow to you as an individual on your own personal tax return. Now, for some people, it's pretty consistent from year to year, and when we do the taxes, we do a little bit of tax planning and we say, pay these estimated payments. And there's 4 estimated payments that you make a year. One at the time that you file, April 15th, 16th, whatever date it is this year coming up, June, September, and January. And what happens is, if you don't pay at least 100 to 110% of what your taxes were the previous year. So let's say your taxes in 2023 were $2,000 you owed the IRS. If what goes to the IRS during the year is less than $2,000, you could get hit with underpayment penalties at the end of the year. I have a lot of people that get hit with those penalties. They're small because it's not a big differential. They might have underpaid a little, or the time when they paid, you're supposed to pay equally throughout the year. And the penalty isn't very high, and they figure, I'm just going to wait and see. But I have some people who have a lot of income, and those penalties can get to be pretty high. So what we try to do is, for some of our bigger businesses, we actually do tax planning almost every quarter to come up with what they might have to pay. I only have 2 clients that I do that for, but I'm sure there's others in the firm. Most of our people, we do tax planning this time of year to know what they should have paid in during the year. Now, if you have personally W-2 income and you've said, gee, I always owe this much tax, I'm just going to have my spouse or myself or whoever who's going on my return take out a little more money out of my pay from where I work other than my business, and I won't make estimated payments. That's okay, you can do that. But if you only have your business, then you better be making some estimated payments during the year for your personal return. Now, if we think you're going to have a loss, and a lot of times businesses do have a loss in their first few years, and sometimes these S corps, especially farms, might have a loss for a long period of time. But then maybe you won't make estimated payments, but it's always worth trying to figure out whether you should or not. So last year, if you owed taxes that was more than a couple $100 personally, you're probably going to want to make some estimated payments. And we're doing that tax planning on some people now, but we'll do that from now until January 15th to say, pay this much on January 15th for 2023. And the reason why is for you to avoid getting interest and penalties from the IRS. So, do you have anything to add to that?
I just want to add, like, this is why it's important, for what we've been talking about in this presentation of, make sure your books are, cleaned up, by this time of year, so you can, if you notice that you have more profit than you did previous year, maybe you can reach out to your accountant and be like, maybe we should, do a tax plan and see, if I should make another payment by January 15th. So keeping your books clean all year is
the unknown for individuals sometimes are investments. So you have personal investments and you don't know what your capital gains are. A lot of people like to harvest losses, especially the last quarter. So we do our best to estimate. And in some cases, we even reach out to the investment advisors that we work with to see where they are year to date. October 31st is a great time, or September 30th, to see where they're at. And then talk to the client, what are you thinking? You've got a huge capital gain. What are you going to do? And I know this doesn't affect your business, but your personal does get affected. So we have to look at that. But let's say you do owe, and you owe more than you think you would like to pay at the end of the year. There are things you can do. If you're a business and you're planning on buying a piece of equipment, and this worked a lot with farms that I worked with, they were going to buy, let's say, a new harvester. I mean, we're talking $1 million, whatever. Do I buy that piece of equipment now or next year? And again, how much will I get to depreciate on that this year if I buy it in September versus if you buy it in December, you're not going to get anything anyway, so you might as well wait and hold the money. But we could talk to you about, if you're saying, I'm thinking of buying a new truck because I have this food truck business. Well, maybe you want to buy it this year. You could fund more into your retirement account. If you have a job, and yes, you have your business, but you have a job too, you could say, put this much more in my retirement account before the end of the year so you can lower your income. You might, if you're an S Corp and you've got payroll or a partnership, maybe you're going to pay a bonus to your employees. Pay it before the end of the year. That'll be a deduction. Pay some of your bills early. If you're going to hold the bills and you're going to pay them in the new year, we might tell you, you better pay them this year. You really are a cash-based business. Most of you, 99% will be. You could pay bills, you could ask people to give you bills. Now, they might not want to do that. They might not want to claim the money in this year, but that's your option. So when we look at tax planning, we look to see if we think you're going to owe taxes on April 15th and how much, and we make a recommendation. Either do one of these things and see where you're going to end up, or here's what your estimated payment is to make on January 15th. And that would be state and federal.
Yeah, and the biggest thing to get out of this right now is that although the estimated payment isn't due until January 15th, if we are doing tax planning, you can't do you can't buy the new equipment or pay the bonuses or pay bills early unless you're, doing your planning now. Stuff like that has to be done by December 31st in order for it to count. So keep that in mind as well.
Yeah, so don't do your plan and then think, well, I'll do it January 2nd. That's in the new year. So any tax credits, and I think you've got a slide on tax credits somewhere. Do you?
Well, some of the new ones, I think.
Yeah.
So.
Okay, we'll talk about that in a little bit, but there may be some tax credits to consider. And even on the personal side, there's some new credits that you might take advantage of if you're thinking of purchasing solar panels or electric car or something. S Corp or partnership, company and personal tax plans. So we just talked about that. And again, in this tax planning would be a good time for us to say, you're making a whole lot more money than we thought. You're doing really well. You've got some employees. You're at Schedule C. We think you should think about being an S Corp. Put everybody on payroll, because on a Schedule C, you can't have payroll. Or you can have payroll. I'm sorry, you can't go on payroll. You could put yourself on payroll. So there'll be things that we might recommend.
Yeah.
Okay. Okay, I mentioned IRA contributions, or I mentioned the retirement contributions. You yourself can make an IRA contribution. You do have some time after the first of the year to make that contribution. I think you have to make it before tax day. Talk to your investment person. I'm going to talk about a few things that might get a little confusing depending on your age, but they're worth considering. Some people, there's this option to roll some of your IRA over to a Roth. Now, if you don't have a Roth and you are within the limits, I think it's like 250,000 or 230 before you are not allowed to open a Roth. I would say open a Roth as soon as possible. If the Roth goes away, you're going to miss out on something right now that would be an advantage to you in the long run. Roth IRAs, are not tax deductible when you open them, but everything you earn is tax-free. Now the government's talking about changing that, but they haven't, and I doubt they'll do it without plenty of warning. So you're either going to pay the tax now or pay it later. And people say, I'd rather pay now. Some say, I'd rather pay later. We're watching the tax brackets rise. If you're young and you're starting to save, you may have a lot more money by the time you get to be my age than you thought you would. And you're going to pay an awful lot of tax. Or if you leave that money because you die, somebody's going to take it out of that IRA and only have 10 years to do it. And it might be a young person in their 20s. And if you leave $1 million, they have to take over 10 years. That's an awful lot of income for a young person. And it's going to change their entire tax bracket. So if you have an investment advisor it's worth talking to with your accountant, think about opening that Roth IRA. Consider moving some IRA money to a Roth. You can roll over an amount if you've owned it for a certain number of years and you're over a certain age. Pay the tax now. That's up to you. If you are over 60, 72 and a half, which some of you may be, and the age may change, you can take all of your IRA distributions for the year and donate it to charity, and it's not income to you. You can open a 529 plan, or you can convert your 529 to a Roth IRA, and it's up to $35,000 in 2024. In the past, if you didn't do that, and I have somebody who hasn't done it, and now they're going to cash it in, and it's quite significant, the tax on that. If you get an inherited IRA, it's a 10-year withdrawal. And something about New York State, everybody says, oh, New York State taxes are high. Yeah, they are, but there's things in retirement you don't know about. There's no tax on certain pensions, like if somebody was a teacher or in the federal government, the tax might be lower. Your first $10,000 each of retirement. So if you were two people married filing joint, that's $20,000, 10 each though. It's got to be your own retirement money that is not taxable, and your Social Security is not taxable. Anything else you can think of?
Yeah, so I'm just kind of to wrap this part up. These are the things that you should be kind of thinking about when you're doing tax planning with an accountant. There are plenty of options, and make sure you're asking questions. So, trying to save you money. Oh.
Employer retention tax credit.
Yeah, I don't know if you guys have done this or not, but if you have payroll, you could be eligible for some of that tax back. Some of this had to do with the COVID rules. So if you do have payroll and you haven't talked to your accountant or payroll company about this yet, reach out and see if you're eligible. Like, there are people getting a lot of money back. You just have to go through the rules and kind of look at your income. But if you do get a refund, it's for tax years 2022 or 2020 or 2021. And you're receiving that, 2022 or 2023, you're required to amend those prior year returns, but it's usually worth it for the amount of money that you're getting back. I'm not going to go into too much detail on it, but make sure you're reaching out to your payroll company and or accountant to see if you're eligible if you haven't already, if you had payroll in 2020 or 2021.
We recommend that you seriously consider, you listen to the ads on TV, and we're finding that some of those companies are doubling the amount that we believe is reportable. And you've probably seen in the news where they suspended submissions for a little while. They're starting back. People also have a period of time to withdraw if they think that they did it and they didn't do it right. Talk to an accountant if you haven't. And if you plan to do this, you need to get it in because it's going to get shut down. But if you do, just an example, I just ran an ERTC summary for someone who did go to one of those companies advertised on TV. They actually got a few $100,000 more back than we thought they should have. But the problem is that the fees that are being charged are significant. It's 25%. And I don't believe accountants, if they're doing it, are even charging anything near that. We are not. Ours isn't even close. And the thing is that we're also, just making sure that these get reported in the proper year. So be cautious about that. I ran a summary of what the tax would be if they went back and amended the corporation's return or the Schedule C and how it impacted on them. And the differential, some people say, I want to wait and file it this year. I want to take the credit this year. The IRS says, no, you're supposed to take it back. If you go ahead and do that, with this company, I found that by amending the returns, they paid almost personal taxes, 60,000 less over those 3 years than they would have if they waited till 20 to amend or to report it in 2023. So just make sure you're doing it right, because I think the IRS is looking very carefully at these. And I suspect we're going to see a lot of notices, even if they were done right.
Okay, we have a couple questions.
Yep.
Yep.
Isn't the New York State pension deduction $20,000 per person?
No, no, it's 10 per person. Am I right?
No, it might actually be 20.
It might be 20. You're right. Oh my God, yeah. New York State pension. Is it a pension from New York State, or you're saying the New York State pension amount? It might be 20.
Yeah.
It is 20. Sorry about that. Neither one of us caught that when we were doing it. Yeah, you're right. And if it's a teacher, it's not taxable at all. I think there's some others in the education system that are not taxable.
Yeah.
Okay.
So if I open a Roth IRA this year, will that reduce the amount of taxes I could potentially pay?
Not this year. No, you're going to pay tax on that money, but any earnings on that money, you are not going to pay tax on. So in your IRA, when you take that money out, you're taxed on the amount that you take out, and that includes the earnings. If it's a Roth, you're never going to be taxed on the amount you take out. So if your IRA has 100,000, but you only put 50 of that in and the rest was gain, don't we wish, you'll get taxed on 100. If you had put 50 into a Roth and it's now worth 100, you're only going to be taxed. You're not going to be taxed at all. You were taxed on your income. You didn't get to deduct that 50. So basically you were taxed on 50, but it's part of your regular tax. So it's worth doing until they change the rules, and we don't know what the rules will look like. And it's also worth doing if you're looking at consideration of money that might get inherited by somebody else.
Yeah, work with your accountant
And your advisor.
and your advisor, investment advisor, kind of see what goals you have, and what we think the best thing is for you. So
If you open a Roth and it sits there, at least got something in. I have people now that make too much to contribute to a Roth. And that would be a way for them to kind of reduce taxes to their children or people who are going to inherit their money, because they're concerned about that now. So I'm doing tax planning for those people, and it's too late. Now, there are some ways to do conversions, but I'm not going to get into those details. So you will need to talk to an accountant and your investment advisor. New stuff.
How much
Any
can
more
you earn
questions?
with an IRA Roth? Sorry,
Pardon me, say that again?
it just popped up. How much can you earn with an IRA Roth?
Whatever the market pays. Oh, an IRA.
So they go up every year a little bit for inflation on how much you can make. I don't know the numbers. I don't know the figures off the top of my head. It depends on if you're single or married filing jointly, because you combine the income. But yeah, I'm not sure.
I think it's like it might be like 250. It's just gone up. So if you earn more, if you go onto the IRS website or just do a Google search and say, what's the income limit for contributing to a Roth IRA? We can't do that right now easily, but yeah, we'll do it on the phone. I'll talk about this next. Is there another question? We're going to look that up.
Nope, that was the last one.
Okay, so for 23 to 24, here's the increases. So standard deduction goes up to $13,850 for single. And 27,700 for married filing joint, and 20,800 for head of household. So when you think about people who used to itemize deductions, some people say to me, well, I'm not even going to give you my stuff. Well, for some people, especially young people with no medical issues, yeah, unless you bought you can only, in New York, you can only deduct 10,000 of your taxes. Your mortgage interest isn't going to be that high. It's very hard to get to that 27.7. However, clients who are older and might be living in assisted living, or people who are young and have a lot of medical bills, you might reach over that amount. In New York State, it's lower, so you might qualify for New York. So people who, I know, we all know our clients well. And if you're not a new client and you say, well, I don't want to gather all this up, I didn't have much medical, I'm gonna say, fine, just, that's fine, we'll take the standard. But I do ask questions. And if I don't know you, you're new to our business, I'm going to have you gather that stuff so I get an idea of where you're at. And also, it's good to gather that stuff because some things might help in making business decisions. For example, healthcare paid by a business owner can be deducted in another area. It's self-employed health insurance. There might be other things too. If your business is in your home, there might be a business use of home deduction. So we might need some of that data for that purpose. The other thing is that the tax brackets have gone up. And again, at the IRS website, you may see that we have them right here. So they'll be in the slides. I don't have last year's to compare, but you can see where you might be based on the income. So if you're a single filer making under 200,000, you might be in a 24% bracket. Last year, maybe you were in the 22. So it has jumped up. Right, do you have an answer?
Yep, yeah, so for the Roth IRA income limits, it's 153,000 for single and 228,000 for married, so.
So if you're making less than that, it doesn't hurt to open a Roth. You're not going to get the deduction now, but you can always put money into it and save in the long run. Okay. Our required minimum distribution. So if you're 73, you're required to start taking money out of your IRA. That's for 23, 24, and it depends on the date of birth. That used to be like 70 years old, and it went up to 70 and a half, then 72, and now it's 73. But it reaches a point, I have a lot of clients in this group that end up just donating. They just donate all the required minimum distributions, because if you do donate right out of your IRA and the investment person sends it to that entity, you're not taxed on it. And so we look at that because the taxes might be worth doing that. You don't get to deduct any more of those contributions as itemized deductions, but this is a way you can do it. And even if you just want to give a little, if you are over 70 or 73 or over and you're giving donations, do some of it out of your IRA, because it reduces the income. Your required minimum distribution becomes taxable for the IRS. Now, the amount of your tax will depend on your tax bracket. So do all your contributions from your RMD. And if your investment advisor says, well, I have a limit, you can only do it if it's 250, you can push. They should be able to do it regardless. There's an energy efficient home improvement, so there are some higher credit percentages, and you can take it every year. Business accounts through Venmo or Cash App, you will receive a 1099-K, and you have to report that. Increased numbers of IRS and New York State notices. So I'm going to go back to this 1099-K. We're back and forth. We don't really know who's going to end up getting those. We know for sure people with Venmo and Cash App. But Jessica and I were talking the other day, somebody runs the football pool at work and they collect all the money on Venmo. Are they going to get a 1099-K? Do they have to report that as income? And I'm thinking, I don't want to be the person who collects that money because I don't know. I had another person ask me, a friend of mine sold all her clothes on one of these apps and was collecting by Venmo, and she got 1099-K. And I said, yep, you're going to pay, or she's got to pay sales tax on it, and it's income. So I don't I don't know what you're going to get, but be cautious and be looking for it, okay? And the 1099K might not come as a paper. It might be sent to you if there's a Venmo kind of app that you're using or a Cash App and they report your numbers, it might be there. So look for it because it has to be out. That's part of that 1099. It has to be mailed to you by January 31st.
Yeah, and you'll be seeing those for, you know, if you, it says it should only be for business accounts. And for any like goods or services or any services you provided, where you receive more than $600, it's like that magic 1099 number. You're gonna be receiving this for, and we're not sure what it's gonna look like yet. It's new for this coming year. They have been talking about it for a while. 'Cause I know the limit, the biggest change is the limit used to be $20,000 or so many transactions, but now the dollar amount is down to 600. So we'll see. I'll personally see because I do I do one of the football pools here for work. So I might get one myself. Hopefully not. But yeah, if you do receive those, make sure you reach out to an accountant and see what the best way to handle it is. So just watch out for that.
And we mentioned we're seeing a lot of IRS and New York State notices. Some after people have filed their amended returns for the ERTC, but there's just others. New York State is just blasting us with notices, and a lot of them are not right. And we've got to gather the data and send it back. So we don't know why it's happening, and we can only think that the state figured maybe they can get some money, and that's the way they're going to do it. Mm-hmm. I had one notice this past week where the IRS changed the whole return, or New York State changed the return because they claimed some mortgage interest on a building they rent for their business. And a 1099 wasn't issued, but it was part of the loan summary document. And what we had to do is go and get that loan summary and prove that we did pay that interest and send it in. I haven't heard yet whether they've approved or not, but it's a rental office building. So the mortgage interest was well over $15,000, and you can imagine what they were trying to get from him in taxes plus interest and penalty. Mm-hmm. So if you get a notice, sometimes it's easy. They might say, we need a copy of this W-2. New York State will do that because there's things they don't get. That can be sent in, and usually it suffices, but if you get a notice and you don't understand it, you better find an accountant if you don't have one who can help you with that.
All right.
For the 1099K, would that also apply for platforms like PayPal or Zelle?
Yeah,
probably PayPal. I think Venmo actually owns Venmo. So yeah, it could be for them as well. I wouldn't be surprised. So
I think PayPal.
I don't know if they already signed one or not.
I don't know if they have in the past. I don't know.
Yeah, it's all very new, and they don't have a ton of information out on it yet. A lot of the speculation from like other accounting firms and things like that is kind of what we're.
Well, the thing we should, the thing we should say about 1099s, if you get 1099s yourself or your business, add them up. If the amount of the 1099s is more than you're reporting an income, then you better make sure it agrees to those 1099s, or you better get one corrected if it's wrong. So a lot of times with Schedule Cs, and the IRS loves this, is they're going to look for that because there are a lot of people, they might collect in cash and they don't report it, but their vendor or the person paying them is smart enough to know that they don't want to get caught like you guys should be, and you're going to issue a 1099. So I have this business that I work with, and they have a cleaning person, and she gave us her her W-9, and so we're hoping she's going to report it. But I have other places where they won't give us a 1099 or a W-9, and we're going to report that income, and so just make sure that you add them up and they total what the amount is on that of your 1099s. The other thing I want to mention, which isn't in our slides, but If you are using somebody to do services, you should make sure that they have, if it's an individual who owns a business, it doesn't apply. But if they're hiring people to do work like repairs, like cleaning, ask them to show you, ask them for a copy of their, or proof that they have workers' comp insurance, and they probably should be listing you as a loss payee on their liability. If they don't have workers' comp insurance and they're cleaning, and this is another issue we had this year, workers' comp did an audit on my client. They've been paying their workers' comp insurance, but the cleaning service that they used never had workers' comp insurance. And this company got charged back so many years because they had to pay the penalties, interest, and the insurance. And they had got a $200,000 bill for 10 years for this other company that they used for cleaning who didn't have workers' comp insurance. So you better, I've got a small museum I volunteer for, and we're trying to find somebody to clean. And everybody we talk to, they don't have workers' comp insurance, but they have employees, so we can't bring them in. It's a nonprofit, and because I'm the treasurer, I'm not willing to let them bring them in. So we can't find anybody to clean the business. But I don't want to run into that problem and have to pay their workers' comp insurance, or you put them on your workers' comp policy, or you add them as employees, and then that's your way around it.
Yeah, and going back real quick for the Venmo and PayPal stuff. I don't have a PayPal, like I have used Venmo. I was kind of messing around on the app the other week when Linda and I were talking about this new change, and I wasn't required to enter in my social security number or anything to get it set up. I think you have to do that if you like try to add like a business account. You have to put like your EIN or whatever it is in. So if you notice that you're being prompted to fill in that information, that's a hint that they're probably gonna send you one, would be my guess. I haven't received anything like that, but I was going through it. They don't have my information to send me a 1099-K. But I imagine if they're gonna be asking for it, I don't know if they're gonna suspend use if you don't, provide them with the information that they're asking for. Maybe if they reach out and, I don't know, tell them that it's not, business if it isn't or something like that, but, definitely watch out for it. We don't know what exactly is going to happen yet, but just want to give you guys a heads up. Any other questions?
Will you be sending the slides after this?
Yeah, I think we sent them to Tim, and
Yeah, I think, Melissa, don't you guys usually send the slides out to all the participants?
okay.
Yeah, we normally send them out after, just asking if they got sent over yet.
Yep.
But yes, the slides will be made available afterwards. We had a couple questions about the slides.
Okay. If anybody has other questions, you can go ahead and email one of us or both of us or whatever. If you have an accountant, please talk to them. If you don't and you do ask questions and it requires significant amount of help, then we're going to talk to you about working with you in the future or finding you an accountant. If not, we don't have a problem answering some quick questions. So don't hesitate to reach out.
Okay, so let me just jump in for a minute and say thank you very much, Linda and Jessica. I thought there was a lot of great, very detailed information there. So really appreciate your assistance in presenting. Everyone on the Zoom call here, just wanted to let you know there will be evaluations coming out later today. So if you could complete the evaluations, that'd be appreciated. And thanks again, Linda and Jess. And anybody have any last minute questions, feel free to put it in the chat.
We have one last minute question.
Sure.
Or two. If a vendor doesn't provide a W-2 for work done for prior years and you filled the taxes already, is there anything you can do?
Wait, a vendor, if you get a W-2 if you're an employee. If you're not an employee and it's a 1099, if they didn't issue it, it's not on you. You should report the income. That's where they're gonna catch them. If you get audited and your income, they start looking at your books and they see you used XYZ company, and it was significant. It wasn't like $50, something they're not looking for. They'll go back to that company and audit them, and then they're gonna get dinged for that money, the amount of money that you saw for not filing, and interest and penalties and everything else. So if you don't get one, that's where I said if your income has to be at least the amount of the 1099s. It's usually more. The only businesses I see where they have a problem figuring that out are medical, because of the timing of when the money gets reported versus when it gets posted. And a lot of times that weekly payment is significant. Some of these medical practices are getting, thousands of dollars. It might be 80, 75,000, 100,000 a week, and they could be off that because of the timing of when it gets posted versus when it got reported by the vendor, the insurance company. So just make sure you've got enough reported. Wait, you said another question?
Yep. When reporting inventory, am I reporting the amount I paid for each item or the purchase price from my boutique at the time of reporting? For example, a pair of earrings costs $3.95 to purchase from wholesale vendor. I charge $9.99 to my customers. At the end of the year, I have 10 pairs of earrings in my inventory. Do I report $39.50 or $99.99?
$39.50. It's what you paid.
That's what you paid.
And just another comment, don't forget about sales tax. It's not a year-end thing, but make sure if you should be registered for sales tax, you are, and you're paying sales tax quarterly. Initially, they'll set you up quarterly. They may change it to annual or monthly. So in that case, with earrings, you are collecting sales tax and you have to report it. Make sure you're doing that. Don't be late on those, and file them. If you're our client, we will handle those for you. Any other questions?
What about when you pay a vendor fee to someone? Do you need anything?
Tell me what a vendor fee. Tell me what you mean by a vendor fee.
We'll have to see if she writes it in the chat. We paid. They pay to set up at an event, like
So you're paying a fee to attend an event.
to set up the event, like a vendor.
If
who has a table.
if you're setting up the event, if the event is yours, and vendors are paying you, then you're not really providing a service. You have the place for them. I would ask my accountant if I needed to do that. But if you are paying the fee to attend an event, then it's just an expense, and they probably aren't going. I haven't seen 1099s for those. It's not really rent. Yeah, I haven't seen 1099s. I'm not going to tell you not to do it if you're the one holding the event. Normally, if you are, then you're probably usually it's a nonprofit anyway, or a group.
No, there's someone who pays for a table to sell.
No, that's just an expense. You don't have to do anything. Remember, you're only giving a 1099 to a vendor who provides service. So somebody comes and repairs something in your business, or somebody I have a place where they make tables for a venue, and those tables, the guy does it, they make them, we give them a 1099. Normally you don't for things that you buy, but this guy hand makes the tables that if you give them a 1099 and they didn't need to get one, it's not perfect. So I'd almost rather give one than not. When in doubt, give a 1099. Anything else?
A 1099 or a W-9?
Well, you're going to get a W-9 from them, and then the W-9 is the information, that you collect, that then you produce a 1099 to give back to them. The vendor is going to give you, the person that is doing the work for you, the vendor, will fill out a W-9. Then in turn, in January, you will issue a 1099 to that vendor for the total amount that you paid that vendor for the year. So attorneys are one that you use. So during the year, you pay the attorney to set up your business. And I don't know why you have to give them to attorneys. They're the only professional that I can think of that is required to get these 1099s. So they're going to give you a W-9, and all attorneys will give you a W-9. You won't get an issue, and sometimes I call for the client, or sometimes we have a W-9 on file for another client for that attorney. But if you use, like I mentioned, a cleaning service, or somebody to clean, if you have somebody who moves stuff for you, you know, they come and they take your stuff and move it to another location. Or if you have somebody who comes in and does some work for you, maybe your bookkeeper, you have a bookkeeper who's doing work for you. You probably would give that person a 1099. But again, you got to get a W-2. So it's typically, you know, you hire somebody and you pay them to do these odd jobs. They're going to get a 1099 if they will fill out a W-9. If you're really confused about that, then give us a yell. We'll help to clarify or talk to your accountant.
That was the last question.
Always 1099s.
Okay. Okay, that was the last question, I guess. So that's the end of our program. I'd like to thank Tim, Linda, and Jess for speaking with us today. A recording of this presentation will be emailed to you, and it will be also posted on our YouTube channel. And I hope everyone has a good rest of their day.
Thank you.
Thank you.